is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Fernando Luque, editor for Morningstar in Spain, and today I'm joined by Jana Selanova. Jana is portfolio manager at Forum Securities, a company specialized in real estate investments. And Forum Securities has launched, in collaboration with LaFrancaise, a new fund dedicated to real estate investments, LFP Forum Securities Global Income Real Estate. Thank you for being here, Jana.
Thank you, Fernando. It's my pleasure.
My first question, Jana, is about rates. What are the characteristics of rates? Because, I mean, the investor experience, especially for a Spanish investor, has not been really positive in real estate investments. But rates is really different from investing directly in real estate. What are the characteristics of the rates?
Yes, it's somewhat different, but to some extent it's a little bit of the same as well. Actually, when we invest in real estate securities, we don't just limit ourselves to REITs. We look at REITs and we also look at real estate operating companies. At the end of the day, the nomenclature is irrelevant to us. It really comes down to our ability to reach the best risk-adjusted returns from real estate investments around the world. But REITs is a subcategory and a relatively relevant one of our investment opportunities around the world. About 2/3 of the world today can be labeled as REITs. It's not really a homogeneous structure around the world, but REITs do share some common characteristics. One of them being that typically you gain tax transparency, i.e. these companies don't pay taxes, provided that they pay out at least 80 to 90% of their dividends, of their net profits in forms of dividends. That typically restricts their ability to put capital at risk into development projects, or actually limits the exposure to development and makes them less risky than pure developers. As I mentioned earlier, it's not a homogeneous set of legislations. Every country has their specificities, and actually REITs in Asia are quite different from REITs in other parts of the world, in that sense that they have to be typically externally managed, they cannot get any involvement in development, and they have restrictions on leverage. That makes them even kind of less risky than many of the companies in the US, in Europe, or in Australia. But investors typically don't like or don't have positive predisposition for externally managed vehicles. In Asia, there is nothing we can do about it. The legal structure prescribes that all these vehicles have to be externally managed, and we have to live with it. But if we have a choice, we typically see better alignment of interest in internally managed REITs in other parts of the world. Most recently, we also have had REITs developed in more exotic locations, like in Mexico. We have had discussions about potentially REITs being launched in India and in China, and we welcome all these positive developments because it introduces different risk-return profiles into our universe. And in Spain, we had SOCIMIs launched more aggressively in 2014. I think the specific of SOCIMIs has been that they have resembled more private equity-like funds that have been launched in a public equity format. So to us, they have represented a somewhat convoluted investment opportunity in the very beginning, because companies have raised cash to invest in real estate, but it hasn't been backed by bricks and mortars. And from that perspective, we like to invest in companies that already have portfolios of assets and management established, and we can see the portfolio growth from a certain base. In Spain, that hasn't been the case, because these companies are promising that they will invest the money in potential opportunities, and it's a little bit hard for us to understand what assets they will be acquiring and at what prices. So we have done our due diligence on all these companies, and we want to see how they develop before we put money to work in this space. But we acknowledge that it's a positive trend, and unfortunately it was the crisis that led to this evolution of this industry. But we would be very happy to see the industry grow further, and we hope that the local managements will be able to source interesting investment opportunities for investors.
Okay, I know that the investment process that you are implementing in this new fund is quite peculiar. Can you summarize this investment process?
Yes, we have, as I already mentioned, have been always focused on understanding a return in relation to risk. And that really has helped us to structure products or investment opportunities with a characteristic of outperformance without necessarily taking on more risk. When we do our analysis on 700 companies around the world, which is actually twice the size of the general index, We focus on understanding what's the net asset value and cash flow potential for possible future generation on a 3-year basis. We think that doing 5 or 10-year cash flows becomes a little bit more of an academic exercise. We like to have a certain visibility, and typically in real estate space, our visibility is on a 3-year horizon. That allows us to understand potential new supply, potential demand drivers, and potential evolution of rents and vacancies in every single market. Hence, we concentrate on a 3-year time frame. As I mentioned, we do a lot of return analysis, but I don't think we necessarily create some extra value here. We use all the same common denominators like anyone in the real estate industry does, and that being net asset value, discounted cash flow, and understanding per square meter, per square foot, per room value. I think where the point of differentiation comes from is how you extract information, how you synthesize it, and how you actually make sense of valuations around the world on a consistent basis. How do we know that Japan is more or less interesting than, let's say, the UK? Because ultimately we want to put money into the investment opportunities that are going to give us the best total return going forward, irrespective of a benchmark. I think the other point of differentiation is really how do you understand risk and how do you assess risk on a company and macro level. We have developed a 13-factor risk model where we want to understand risk factors on the real estate side, on the company side, and on the security side. And having done that, perhaps we will see that an investment opportunity in Brazil only makes sense for us because of the higher embedded risk in an emerging market if we get compensated with above average expected return. So if we have a 14% return opportunity in Brazil versus a 12% return opportunity in Germany, typically the risk associated with an investment in Brazil is going to be substantially higher than a risk involved in an investment opportunity in Germany. That would make the 12% perhaps more attractive than the 14% in Brazil. We always consider risk and return in our investment process. I would also like to make the distinction that we have been in the market for over 10 years, and we have launched the first generation product 10 years ago, which was very much a long-only real estate product, pretty much benchmark driven, that was giving clients access to the asset class. That's what all our competitors have been doing. But I think with the crisis of 2009 and with the very low interest rate environment that we have been in and valuations that have come up, we have acknowledged that there is a need for the product to be more total return focused, and that involves certain hedging instruments that we have been implementing into our real estate strategy. I wouldn't necessarily call it a hedge fund because it's almost impossible to reliably hedge risks in all the different geographies, but we have tried to implement different tools to reduce volatility of the product and thus to be protected against an adverse movement in the market. We have identified a couple of risks that we would want to protect our clients against. One being the risk of very severe market deterioration, and the second one being a risk of market fluctuation in somewhat more subdued territory, but yet a negative return. We use different instruments to hedge against these different risks, and typically they are centered around put options on different global indices and on shorts on separate real estate companies that could actually give us that protection if there is an adverse movement. But I would like to highlight it's not an actively traded hedge fund. These products are more aimed to reduce volatility by securing positive total return in any environment.
Okay, and finally, given this methodology, where are you seeing value, or which regions or countries are most undervalued, or what do you see value in the current real estate market?
I think that the perhaps biggest risk that is on most people's mind is that what's going to happen to real estate when interest rates go up. It has been an asset class that has benefited very much over the last 5 years from very low interest rates, and actually has been the best performing asset class when compared to bonds and general equities and even to direct real estate. So I think that question is very pertinent, and I would like to highlight that because we are dealing here with global markets, typically you see very wide dispersion on country basis in terms of annualized performance. Some markets can appreciate as much as 50-60%, and others can deliver market depreciation of about 50%. We are not obliged, because we don't follow a benchmark-driven strategy, exposure to all markets at all times. And I think that gives us the flexibility to really cherry-pick the markets where we see the best opportunities. Given what I have just said, we perhaps see a risk of possible interest rate hike in the UK later this year and in the US in 2015. While we don't think that it's going to be any massive interest rate hike, we think that this message will signal a certain inflection point in performance of public real estate markets in these two countries. And hence we are more cautious on the UK and on the US, also on valuation grounds and on this potential negative inflection point that could, at least in the short term, create some adjustment opportunities. If that adjustment came, we would perhaps see an interesting entry point again to be more involved in these markets, because we think that over the long run, the interest rate increase is not going to be very severe. And if there is an interest increase, that will suggest that these economies are growing faster, there is greater propensity to spending, there is greater propensity for office demand to be rising, and that all going to transform itself favorably into revenue growth on the profit and loss statement of our real estate companies. But in the short term, that could be a negative. Hence, these would be our least preferred markets. We more today like markets that are either categorized as emerging markets, because those have underperformed over the last 2 to 3 years, and because we start to see some interesting values in markets like China, Brazil, and also we see very positive development in the Mexican real estate market. If we speak about developed markets, our preferred exposures today would be in Australia. It's the market that has reduced interest rate as the last one in the set of developed markets, and the cap rate compression on the real estate side has been catching up with some other markets where we have seen this trend play itself out earlier, like the US or the UK. We also like markets where the central banks are not in any rush to raise interest rates, like the Western European markets or like Japan. So that's where perhaps more of our positioning is today geared in the fund towards, and where we think we can generate total returns.
Okay, excellent, Jana. Thank you very much for your views on the global real estate markets. Thank you very much.
Thank you for your interest, and hopefully we believe that the 8% returns are achievable on a more hedged approach rather than necessarily on a long-only basis going forward.
Okay, perfect. Thank you very much.
Is run by LaFrancaise investment bankers, and their modus operandi